pleasure to introduce Bradwin Roper. There is a very, very beautiful bio here, which is quite extensive, but I'm going to do my best to summarize it. Bradwin believes in the power of tech for good to drive inclusive growth and transform lives. His career is at the intersection of FinTech, financial inclusion, and exponential technology. He currently leads payments and partnerships at Jumo, scaling digital financial services across emerging markets, and previously headed MTN Momo South Africa, growing it to millions of users, and led F&B Connect, which was recognized as the world's best digital MVNO. Round of applause, good people, for Bradwin.
Brilliant. Hello, everyone. It's good to be here. What if I told you that there's a company that does 7 loans a second? 7 loans a second. I checked the stats as of yesterday. We did our peak performance of 182,000 customers in a day. So that's the equivalent of, I saw a picture of Glastonbury. That's the equivalent of the entire Glastonbury attendees. We did 182,000 customers in a day last month. And we did $190 million worth of loans dispersed just last month. We are not well known in South Africa. We operate predominantly out of Africa. And we do use AI for scoring and underwriting. So I want to talk to you about a little bit about banking as a service in Africa and just leveraging our company Jumo as a use case. I mean, I'm not going to bore you with the definitions, and we only have 20 minutes, and I'd like to invite some conversations. I think the only thing I'd add on to the definition of banking as a service is, I guess, in the bottom left corner, if you're not partnering with someone that can leverage AI as part of the solution to your offering, then I think you might be losing. It's not just about open APIs, etc., but you have to be leveraging the best in breed in technology, which includes AI as a technology infrastructure. It has to be embedded, so it has to be at the point of contact, specifically in Africa, where we have agents on the ground, where payments are happening, or on mobile devices, and in particularly in Africa on USSD. We have a 60% connectivity gap in Africa, so that means 60% of Africans are covered by a network infrastructure, but are not connecting to the internet using mobile data. And that is because of a lack of devices, particularly smartphone devices. So for the most part, Africans are connecting using USSD as a channel. And of course, it's got to not be a zero-sum game. So we're talking about ecosystem expansion. There's got to be a win-win for the distribution partner. In our case, we use the telcos. There's got to be a win for the bank, where they have specific licenses. There's got to be a win for the technology provider. And ultimately, there has to be a win for the customer or the end consumer. So I guess, what are the barriers? So now that we have the definition of banking as a service, what are the barriers? So in Africa, we only have 5 bank branches and 7 ATMs per 100,000 citizens. Now, if you think about it, the mobile money revolution, there are 800 agents per 100,000 usage points. So if you think about why has M-Pesa, we heard about M-Pesa, why has Momo garnered over 70 million subscribers, why does Airtel Money have 50 million subscribers, is because of that agent network, and those agents are embedded into the communities where you find them. And so these big infrastructure deficits exist and are prolific across the continent. We don't suffer as much from it in South Africa. The other thing is, the other, I guess, big deficit is the fact that credit penetration, so when we talk banking as a service, I'll specifically hone in on credit, and I'll tell you why in a slide or two's time, but credit penetration is at less than 10% across the continent. And there are structural reasons for that. And then, of course, in the digital divide, I spoke about 60% of Africans being covered by sort of 3G, 4G, even 5G now, but not connecting to the internet because of a lack of, infrastructure, smartphones, etc. And again, that's because of a lack of affordability on a device. So there's this massive digital divide. It's pervasive in rural economies, it's pervasive among females, and especially in underserved communities. Now, the reason I want to speak to specifically just credit is because the telcos have leaned in quite heavily on that infrastructure gap. And so when you look at that sort of middle column, you can see that actually when you talk about financial inclusion, and you expand the definition to mobile money wallets, you can see that we actually have, in the form of moving money and payments ecosystems, when you include the mobile money ecosystems into the equation, you can see that we actually have a relatively high level of financial inclusion. And so I don't believe that there's any space left, particularly in Africa, to really innovate around sort of deposit taking or traditional savings. I think the telcos have done a superlative job there. And even from an account ownership perspective, you can see in the last decade, this is just in the last reporting period, you can see a move from sort of 23% to 55%. But where we find ourselves now, that second column is up to 2024. Kenya, we've got 79% financial inclusion because of M-Pesa. Ghana, you've got 70% financial inclusion because of MTN Momo, who lead there. South Africa, you've got 85% inclusion. That's predominantly a bank account that you have in South Africa. But you still have some laggards on the continent. So you still have laggards in, for example, Nigeria and Egypt. So I guess there's space, and you'd have to look at some of the country nuances to see, if you want to do banking as a service. There is space in certain geographies to do traditional sort of moving money or payments innovation or deposit-taking innovation. But for the most part, mobile money has been the revolution that has sort of mopped up on that gap. And it's pretty astounding to think that 1 in 3 Africans, adult Africans, use mobile money. A third of all Africans use mobile money. We account, as opposed to sort of 10%, which is the global average, we account for 50% of the entire globe's mobile money use base in Africa. And so we really have, from a banking perspective, we have a lot of gratitude to pay to the likes of Airtel, Orange, M-Pesa, and MTN, because they've really sort of just leaned in, and particularly on that agency model. And so I think the next big gap then, if you think about banking as a service, is lending. So if you think about 10% credit penetration in lending, that presents a massive opportunity. So again, just talking about the mobile money revolution, some stats for you. We've got 1.1 billion mobile money accounts. Half of them are active every single month. So that just counts the 30-day active. So 500 million Africans leveraging mobile money in Africa. The transaction growth, we've seen about $1.1 trillion. That's 1% of global GDP in 2024 happening on these mobile money wallets. And growing 15% year on year, so still massive double-digit growth. And as mentioned earlier, we are sort of the global leaders when it comes to mobile money on the continent. And so this fit then between banking as a service, banks, and fintechs. This is what I spoke about looking for these sort of win-wins, is one, fintechs can help banks monetize their infrastructure. You heard in the previous panel, it's very expensive to start up a bank. The regulatory requirements are incredibly difficult. Deposit-taking franchises are really expensive. Deposit-taking insurance requirements are becoming prolific across the continent. And you have these banks that have all of these big sunk costs and the incredibly compliance burdens that the banks are subject to. So what fintechs can then do, we know if you look at the structure of South African banks, are incredibly well endowed with massive deposits, but just unable to lend. So fintechs can really sort of help monetize this infrastructure. What fintechs can do is provide innovation at the edge. So it doesn't have to rely on sort of legacy systems, SAP systems, or these big legacy systems. Fintechs can come in and innovate at the edge, which doesn't create too much technical debt and burden for the banks. And then why you would need a partnership model is you want to then partner with someone who has reach. So if you think about 800 agents per 100,000, MTN boasts something like 250 million subscribers. They have incredible reach across the continent, these telcos. So what you want to do is partner with someone who has incredible reach. So look for scalable partnerships. And of course, the baseline of this has got to be through APIs, etc. But also, what is not said on the slide is you have to have a strategic mindset for these things as well. So strategic partnership mindset. So you've got to be looking for four-way wins: a win for the bank, a win for the fintech or the technology provider, a win for the customer, and then ultimately, a win for, so it's telco, bank, or distribution partner, bank, technology provider, and customer. So you've got to approach the concept with a four-way win mindset. We've spoken about digital transformation, the massive market potential of, how do you tap into 500 million Africans that have wallets across the continent with a 10% credit gap. Actually, the insurance gap is even wider, but I think there's specific needs on credit lending. The insurance gap sits at 2%, but I think if we've got to be sequential in the way we do this. So we've got deposit taking sorted. If we can crack credit, then we can start moving customers into, insuring themselves, their families, their livelihoods, and potentially their assets. The insurance gap is pegged at 2% on the continent. And of course, there was a lot of conversation previously about AI. How do we leverage AI? We can use Africa as the case study that leapfrogs in the same way that we leapfrogged on the mobile money revolution. I specifically think that the best use case of AI in Africa is for lending in Africa. Some of the baseline, in credit, in Kenya, only 9% of customers lend. Specifically, I spoke about digital lending. So what do I mean by digital lending? If you think about 8 branches per 100,000, plus the barriers of getting to a branch we have a very vast geographical stretch on the continent. We have to think digital first. And digital first doesn't necessarily mean web native or app native. I think people have forgotten the power of USSD. So that's, star 120 star, that technology. Most of our loans, you'll see a little bit later, we actually leverage USSD as our technology of choice. And then app, of course, the more citizens we get connected, the richer the experience can be. And of course, you have to think alternative data for scoring, underwriting, and prediction of asset quality. So just getting into sort of Jumo, we've been at this game for a decade now. I want to share with you, I guess, the last sort of 3-4 years of our experience. The blue bar that you're seeing speaks to, do I have a pointer? Okay. So the first blue bar that you would see in 2020 is how many, let's start with the yellow bar. So the white bar is monthly applications. So you can see in 2020, about 5 million monthly applications, 2023, nearly 8 million monthly applications. You would have seen then the qualification rate. So between the white and the blue on the left-hand side, you would have seen our qualification rate increasing. And you would also see we have a differentiation between new business and repeat customers. You can see our repeat customer numbers have been growing, specifically in the last couple of years. Very importantly, we weren't always the successful. So when we started out, our bad debts were pretty high. If you look at 2020, we were in the sort of 12% range. Where you find us now in 2024 and 2025, our bad debt ratio is less than 4% of the money that we've dispersed. In 2024, we increased our eligibility up by 39%. Our monthly applications rose in 2024 by 26%, so we're growing exponentially. And more importantly, we're also growing new customers, so that gray bar, would have grown by 5%. And then very importantly, we do use AI for scoring and underwriting, and I'll showcase that a little bit later. But it takes us now up to 24 hours to retrain a new model and do a new lending model in the market. You have to be that dynamic if you're lending on the continent. And so we can, we reduce that by 50%, so we can deploy new models within a 24-hour time period. On individualized scoring, we spoke about some of the gaps. We lend predominantly, we've seen the inclusion of 21% sort of youth, and we mean adult population and youth, 33% female population, but then also very importantly, 80% of our customers that we lend to are micro SMME customers. So predominantly not consumers, micro SMME customers. And our research also shows that 80% of our customers go on to employ at least one other person. So we're lending to micro SMMEs, and we're lending that creates employment. Most of our SMMEs actually go on to employ at least two other people. So it's labor absorptive in that regard. We don't use, when we started out 10 years ago, we obviously, when our bad debt ratio was at 10%, you would imagine that we would have had to deploy our own capital because banks wouldn't want to deploy that. But where you find us now is 99% of our lending is done off balance sheet. So this is where the banks are now lending through Jumo, leveraging our IP, and you can see that exponential growth. Very importantly, what you're seeing on the blue bar graph is the amount of capital deployed, so less than 100 million, now over $500 million worth of capital deployed. And you can see that that's been growing exponentially, so more banks are trusting us and more banks are putting money through our system. But very importantly, why do they do that? So the yellow bar shows the yield, so we measure yield at 150 days past due. If we loan out 100 million, what is the yield back? So our yield is sitting on 107 million, so 100 million gets lent out. We get 107 million back at 150 days past due. How that translates into ROAs for a bank is the banks are getting between 60 and 70% ROAs on that invested capital. And specifically, when I spoke to you about the banks in Africa, we have these huge deposit franchises, these big endowments. So you can imagine the trade-off now between putting money in a government bond at a yield of, say, 30%, or putting money through Jumo and getting an ROA of 60%. This is why we're starting to see treasury functions actually deploying capital through Jumo. The bank is effectively the lender of record, so we take care of all the regulatory reporting. We do all the IFRS accounting using AI software, and obviously we give them those files using APIs, so the bank then becomes the lender of record. It's their loan, it's their customer. They're obviously deploying it. We do all of the forward software integration with Airtel, MTN, Tigo, and all of the telcos, and effectively you're getting a loan through that distribution. So we're the middle player. We match supply and demand between the banks now and these massive distribution partners. Very importantly, the reason why the banks particularly trust us is because we've withstood a few shock events. So we've withstood COVID events, and we've withstood emerging market stress. So we've seen things happening in the city. We have a huge operation in Ghana. We've seen things happening with the Naira. We've got operations in Nigeria. So we've also withstood emerging market stress and maintained those yields through these emerging market stresses. So at scale, banks are seeing some really exciting returns. Very importantly, from the mobile money side, so why do they win? So we inject, in 2024, we injected $1.2 billion into the ecosystem. And so what does that mean? That means that if there's new money coming into Airtel, Orange, and MTN, they're buying airtime, they're buying data, they're buying for goods and services. As I mentioned, SMME customers are now buying produce that they can on-sell. We've scaled, and on those menus, we launch, on average in 2024, 4 new products. So if you think about the products, we launched about 4 new products on those menus. And we've obviously introduced, helped increase their customer numbers by 60%. So we can show the stats that actually the main driver of new additions to sort of Momo, and Airtel money and all of these things is actually credit. So we're introducing eligibility for them. And so I think there's a few underlying things. So we're tech fin. 70% of our resources are actually data and software engineers, and we invest very heavily. We're remote first, so we employ the best engineers across the globe that help deploy the software. We invest very heavily. We've got a very low tenure turnover. On average, if you think about what happened in the last decade, our tenure in our technology space is more than 6 years, but also people believe in the mission, and so they stay on. One of the things I forgot to mention in our product shape is we don't compound, so on average we charge a simple interest of, say, 8%. We found that that's really important, particularly in Africa. So it's a simple credit, it's 8%, that's it. We never compound, we don't believe in compounding. And we've been able to maintain those yields. You have to keep the product simple, specifically because you're predominantly doing it on a USSD menu, so you can't introduce weird complexity. And so we don't compound, it's very simple interest. And a lot of the people that work for us believe in the mission about driving financial inclusion, keeping our product simple, being B Corp certified in London because we do things like never compounding. You've got to build your teams to be cross-sector collaboration mindset. So we have to engage with CEOs of banks, CEOs of telcos, and regulators in the countries. We have to actively foster. We're live in 13 countries, and we have 13 country managers. And their main role is for policy alignment in each of these countries. So that's, I guess, the other sort of 20 to 40% of our resource is actually locally deployed across the 13 countries that we operate in. So we're hyper-local as well. And you have to look for policy alignment in the markets that you serve. So yeah, we've seen a massive transformational impact, labor-absorptive impact, inclusive growth, and we believe in the strategic imperative of driving financial inclusion. I'll leave you with this before I share just a history of Jumo. There are about 700 million Africans today that don't have a smartphone. Who here doesn't have a smartphone in the room? 700 million Africans who don't have access to a smartphone. The number one barrier for smartphone penetration is the cost of the device. Our average loan size has crept up to $45. We're looking to creep that up to about $100 over the next couple of months, and because if we can do a $100 loan at a simple interest, we can help solve that barrier. This is our next big mission. Because strategically, the World Bank has shown that if you drive smartphone penetration into a nation by 10%, so if you think about that 60% gap I spoke about earlier, you have the potential to raise that nation's GDP by up to 2.5%. Because it drives consumerism, but a lot of it is actually just activity that is happening, but now it's measurable because it's digitized. And so I think a big challenge here for sort of banking as a service is who's going to be the next player to help solve for $100 to 600 million Africans that don't have devices. Another scary stat I'll leave you with is, in COVID year, who's got kids in the room? So all of our kids during COVID went online, right? So we had an iPad, we had a laptop, we connected them. In COVID, 1.3 billion children went dark across the world, predominantly centered in Africa because of a lack of infrastructure. Not network coverage, lack of an iPad, lack of a device, and actually just a lack of an availability. So we haven't even seen what that'll mean in the next couple of decades, but imagine 1.3 billion children just going dark for 2 years. And this is why you have to be driving financial inclusion, because there's a social impact that you can have on these nations. So this is who we are. 10 years at Jumo. Last year we did 240 million loans, leveraging predominantly AI. We've dispersed, in our lifetime, we've done 243 million loans up to 2024. We've done $7 billion. We've served over 29 million unique Africans. Because we've leveraged AI, we've introduced a 47%, remember I spoke about our simple interest, we've reduced that by 47%. since 2015. And just to compute what we mean by AI, so we have 15,000 unique and predictive features that we deploy across each of our countries that is chewing on alternative data sets to be able to drive that outcome that matches supply and demand. It uses alternative data sets, and this is why we've been able to, do 243 million loans, $7.1 billion, now with a long-term bad debt ratio of less than 4%. So yeah, we're very excited. We're lesser known in South Africa, but if you go into sort of the rest of the continent, we're a business-to-business entity, so we allow, the likes of MTNs and Airtels, et cetera, to thrive, and of course we allow the banks to shine because the products of the banks are actually named by the banks, but we facilitate sort of all of that. I hope I have time for questions. I was trying to be as quick and expedient as possible. Hey.
Good, thanks to me. Yeah, thanks for the great presentation. Just a quick one, in terms of the reality around data in Africa, the lack of data and creating the challenge to then, offer the loan, take on the risk without the right data. How does fraud play a role here? Because you also have the lack of data creates opportunity for massive fraud. What have you seen in terms of insights around that?
Yeah, so those 15,000 features do a couple of things. They firstly match, so let's take Ghana. We have 6 banks, capital deployed, and we have 7 million active customers that we serve. So those 15,000 features are matching in real time, like I said, 7 loans per second, supply and demand against each bank has a different yield mandate. So one bank will say 107, another DFI will be about financial inclusion, so they're comfortable to break in. So it matches that. And then, of course, it matches behaviorally, leveraging data that we have on the customer, what the predicted outcome could be. But also importantly in that is fraud features. So in those 15,000 features, so you can you can imagine like one customer's applying, but there's 15,000 features that are chewing in real time on that specific customer. We've got, 30 million now Africans that we have data on. They've opted in very transparently for that. We're very much about transparency as well. And so we can leverage insights over there. The other thing that has been the most surprising to us is actually of the features that matter the most, the behavioral features are the ones that rank highest, specifically in Africa. So we don't have, big bureau data sets like we're gifted with in South Africa. And so, 10 years on, most of our features are actually derived on behavioral insights. So we can see, how long you're taking on a particular screen on your affordability. We can see the time between when you were given the offer versus when you've taken that up. That predicts. We can see your loan progression model. So if you're ramping up loans every 7 days, that then becomes a real feature that you can predict. If we offer you $100 and you're constantly taking $100, for three loans in succession, it's not rocket science, but like these are intuitive features. But of course, it's a machine that now is chewing on that in real time without an individual having to make that decision. And so all of those features are actually driving down fraud. And that's why, if we had high levels of fraud, our non-performing loan ratios would be, above 4%. So all of those behavioral features and economics are the ones that are ranking the highest in Africa by design. So again, it's just frugal innovation because we had to, build features of our own.